Hi, I'm James.
And I'm Anthony.
And this is Words and Numbers. And here I go once again down that old familiar path. What's new and exciting in your world this week, Ant?
This episode, we give a shout out to our friend and listener, Andrew Wanrose, who's stationed abroad, has been for some months now.
We miss Andrew. I suppose his family misses him too, but surely we miss him more.
Andrew has been a longtime listener, forwards all of our stuff to various people, annoying them to no end, I'm sure.
Yep, I'm sure of that too.
One of the moderators on our Facebook page, Words and Numbers Backstage, where he helps to make sure that everyone is being nice to each other.
Which only means, Ant, that Andrew Wanrose is the prototypical wanker. Congratulations, Andrew.
You can't say that word.
Why can't I say that? They describe themselves that way. I can say that anytime I want.
Spelled
you go yourself. I'll say any thing I want.
Spelled W&Nkers.
That's right, wankers.
Andrew, be safe.
Take care of yourself, Andrew. We're looking forward to getting you back.
We like to talk about how the world is becoming a better place, kind of as an antidote to all the nonsense you see on the news about how everything is just horrible. One of the things we talk about is the marked decline in gun violence in this country.
Yeah, people don't realize this at all.
And it's incredible. From the 1990s to the present, the homicide rate in the U.S. is down like 50% or more. The firearm crime rate is down like 80%. And, there are years when it goes back up. Actually, it's up a little bit in the past year, likely because of all the COVID business, the lockdown. In times of recession tends to go up as well. But nonetheless, it's down markedly since the 1990s. I ran across a report from the U.S. Department of Justice. This is their Juvenile Justice Statistics National Report. And here, as you might imagine, it talks about crime committed by juveniles. If you look at these numbers, you get the same kind of story. When you're looking at 15 to 24-year-olds, and the report breaks it down into subcategories, and the subcategories all behave generally like I'm going to quote to you here, but generally speaking, 15 to 20-year-olds, robbery rate from the 1990s to the present, down 70%. Violent crime rate also down 70%. Aggravated assault down 80%. This thing that you and I observe of high school students generally being kinder and gentler than they were when we were kids shows up here strongly in the data.
I've asked my children if they've ever been in a fight, and they laugh at me and they say, we've never seen a fight.
Yeah.
That's the common experience for most young people in most places in the U.S. right now.
I don't know how to square this circle. The thing I keep coming back to is the possibility that life has gotten so much better in general, our standard of living, less crime rate and this sort of thing, that deviations from that are more pronounced. They stand out, and so we tend to lose our minds over it when back in the 90s it was just par for the course.
Let's be honest, you and I usually look at economic data and talk about that. It's a rising tide wherever you look at that from American founding to yesterday. But there are all kinds of other ways to determine how good or ungood life is. I would submit that they're just as important or maybe even more important than the economics of the matter.
Yeah, I think the whole thing goes together when you talk about quality of life. As you're saying this, I'm reminded I was driving home today listening to my latest book on tape, and it was a fictional story set in the 1800s. They were talking about one of the characters who was walking down the road, and the story made note of the fact that he was walking because he wasn't wealthy enough to afford a horse, let alone a carriage. And I'm reading that as I'm traveling down this highway surrounded by thousands of cars that even poor Americans would own today. That's far and above the horse or the carriage.
Better than poor, my daughter bought one. She's pretty young and she could afford a car. Is it a car I would want to drive? Well, no, it is not. But it is a car. It has 4 wheels, an engine, and an air conditioner. And what else could you really need?
And I would imagine it's a heck of a lot better than the cars in the 1910s or 20s that only the 1% could afford. And here we've got a kid affording it.
Better than horses.
Better than horses, right.
Smells better, doesn't need as much. I'm going to point to something that shows how things maybe aren't going so well.
All right.
The headline will likely be enough to get you talking for an hour, and I want to avoid that. You're not allowed to talk for an hour. U.S. home prices now posting biggest monthly drop since, and here's the important part, 2009.
It's like anything else. If you're going to buy a house, there's a certain amount that you can afford. That amount can go toward principal or could go toward interest, but the fact is that's as much as you can afford. And as interest rates go up, necessarily you can't afford as much principal, so you're going to have to buy a smaller house.
Well, I don't know if I've ever told the story of my purchase of the house in Greensburg, Pennsylvania, right around the corner from you, come to find out. But it was interesting. I had to get pre-approved by the bank so I can go find a house, bid on the house, have my bid, et cetera, et cetera. I had a very compressed time window. I got pre-approved, found the house I wanted, put a bid on it, got that bid accepted, and then got the financing all underway over a weekend. I was in the bank to get pre-approved. I asked for $200,000. Let's give me $250 just in case I need to drift over a little bit.
Right.
And he looked at some papers on his desk and he said, yeah, no problem. It seemed to me that he waved his hand very nonchalantly when he said, yeah, no problem.
Uh-huh.
I said, well, okay, just for grins, what would you pre-approve me for? And he looked at the papers again. He said, well, you can't hold me to this, but about $450. I don't mind telling you, Ant, that I was moving it to town on the strength of a $47,000 a year job. And I said, I'm pretty sure I'd be homeless by April if I had a mortgage for $450. And he said, and I quote, that's not my problem.
Exactly, because at that point, the banks were issuing the loans and turning around and immediately selling them to the federal government.
Yep. Uncle Sucker is going to pick up the tab on all of those. And I bought that house in 2005. By 2008, it was clear we were in crisis. And by 2009, it was a mess.
Yeah.
I bought a house recently and I saw all kinds of mortgage shenanigans again. Which brings us to the foolishness of the week. Now, 5 years and running.
5 years of foolishness. Who'd have thunk there was that much foolishness out there?
Oh, I would have, which is why we started this. But every week, the dumbassery just gets a little bigger. The headline, NFT trading volume plunges 97% since January, raising questions about their future. Let me get this straight now. Nobody's buying NFTs. Well, who could have predicted such a thing?
You think cryptocurrency is not understandable. NFTs are an order beyond that.
I have an NFT. I got it when I went to a baseball game in Arizona, and as near as I can tell, I have an NFT of a player's picture. I don't want that, and I don't understand why anybody else would. Indeed, the secondary market on that also doesn't provide an answer regarding who else might want this, because I can't seem to sell it for much of anything. Do you really want to own some kind of digital share in a photograph?
Yeah, I understand cryptocurrency, and I do not understand NFTs.
I'm pretty sure I don't understand either one, but I don't understand fiat money either, so I'm in pretty good company.
To get more Ant and James, buy a copy of our excellent book, Cooperation and Coercion. You can find the paper and electronic versions on Amazon and the audio version on Audible. If you'd like to support Words and Numbers, make your way over to patreon.com/wordsandnumbers, where you can contribute to our podcast-making habits. If you'd like to schedule us to come speak at your event, be it corporate or educational, or have James officiate at your wedding, send us an email at wordsandnumberspodcast@gmail.com. Lawrence H. White is professor of economics at George Mason University, where he studies market-based monetary systems. His latest book, Better Money, Gold, Fiat, or Bitcoin, is forthcoming in April 2023. He is also the author of The Clash of Economic Ideas, The Theory of Monetary Institutions, Free Banking in Britain, and Competition in Currency. Professor White's research has appeared in the American Economic Review, the Journal of Economic Literature, the Economic History Review, and other leading economics journals. His popular writings have appeared in the Wall Street Journal and elsewhere. He is co-editor of Econ Journal Watch, hosts their bi-monthly podcast, and blogs at altm.org. Larry, welcome to Words and Numbers.
Thanks. Good to be here.
James and I, over the years, have talked quite a bit about government-sponsored currencies and private currencies, and we're both interested in cryptocurrency. We thought it's time we got somebody in who could explain, kind of in layman's terms, the difference between private currencies and government currencies? And then I've got tons of follow-up questions to that.
Yes, I guess I could claim some expertise in that I wrote my dissertation on free banking in Britain, and I've been milking the topic ever since. It's got many aspects. There's a historical aspect. We can talk about the history of banking regimes that come closest to the ideal of free banking historically. We can talk about the theory, and we can talk about the policy implications.
Let's start off with, what is it?
Free banking in the 19th century referred to a monetary regime with no central bank, where the issue of banknotes, paper currency, was decentralized among competing commercial banks. And so the money supply was not controlled by any central agency like a central bank. It was guided by market forces, you might say.
Let me stop you there, because the first time I heard about free banking, I said, in response to what you just said, what many people will say is, well, what's to stop a bank from just printing as much money as it wants?
Well, historically, of course, the banks were issuing liabilities that were redeemable for gold and silver coin. So basically, the redemption obligation, which they took on as part of the contract, because if you're trying to issue money in a gold standard system, your customers are going to insist that it be at par against gold. And the way to keep it at par is to undertake this contractual obligation to redeem it. So the scarcity of gold reserves is what kept banks from overissuing. And the prompt enforcement of their obligations was important to that.
When we first had paper money, and I shouldn't say first had, but under the Federal Reserve regime, so centralized government currency, paper dollars were redeemable by gold. But then we reached a point where people had enough faith in the dollars that they no longer needed to be backed by gold. Can you get such a thing with free banking?
Well, I'm not sure I would agree that we ever reached a point where people no longer cared about whether their money was redeemable in gold. It took an executive decree, which had been authorized by an act of Congress, for Franklin Roosevelt to take away the domestic redeemability of bank accounts in gold. And there was a lot of unhappiness about it by members of the public. Under a free banking system, I don't think you would get to a point where people were indifferent. They would prefer the option to redeem. Now, people seldom used it. Historically, people paid in banknotes or in checks, and very seldom did people use gold coins hand to hand. Almost all the gold was residing in bank vaults where it was backing bank-issued money. But the option to redeem it is what keeps the bank-issued money at par. And so it's not something that can be done away with lightly. Any single bank that said we're going to no longer redeem would lose all its customers to the other banks that still allowed that.
And then presumably the banks have a profit incentive to figure out on the back end how their various currencies are exchanged across the bank. So Bank A prints its own currency and Bank B prints its currency. They have a profit incentive to set it up in such a way that I, the user, don't care whether I have Bank A versus Bank B currency. Is that safe to say?
It's certainly the case that each bank wants its notes and deposits to be accepted at par, at face value. And so they will make efforts to do that. And in a system where legal obstacles don't prevent it from happening, you get banknotes circulating nationwide at par value. That's what you had in Scotland in the 19th century and in Canada. But you didn't get it in the US because we had rules against banks branching across state lines. With some exceptions, banks couldn't set up redemption agencies across state lines, and so their banknotes fell to a discount if they got very far from the town that issued them.
Are you able to tell us how the Canadians managed?
So they were very similar economies, the US and Canada in the 19th century, both predominantly agricultural and both stretching from Atlantic to Pacific, and both had a transcontinental railroad at some point. But in Canada, the banks were allowed to branch nationwide, whereas in the US, bank chartering was traditionally a function of the state government, and state governments used their prerogative to ban banks from other states. They wouldn't recognize their charters. I tell my students, imagine if we had that in the supermarket business. Safeway or Kroger couldn't just open a new supermarket in another state. They would have to go to the state supermarket commissioner and ask for permission. And under the influence of incumbent supermarkets, they would likely be denied permission to open up in a new state. But in Canada, the provincial governments didn't have that kind of veto power. So there were a dozen, well, at one point it was a dozen, the number changes over time, banks with branches coast to coast. So they would redeem their own notes. Even if they were issued in Montreal, they would redeem them in Vancouver because they were part of a single firm. In the US, we didn't allow that. In fact, we didn't allow that until the 1990s. Such was the great power of the state governments and the small bank lobby in preventing nationwide branch banking.
Are there any major countries that rely on free banking? To my knowledge, they're all government-controlled currencies.
Yeah, they're all government controlled. There are a few places that still have private currency issue, private banknotes, and that would be Scotland and Northern Ireland, Hong Kong, and Macau. But they're not redeemable for gold or silver anymore, which was an international money not under the control of any national government. They're only redeemable for the national fiat money. So in Scotland and Northern Ireland, they're redeemable for Bank of England notes and pound coins.
So the private currency in those countries run alongside a government-sponsored currency?
Yeah, much the way bank accounts in the U.S. do. They're the obligations of private commercial banks, but they're redeemable for the standard money, which is controlled by the Federal Reserve System. And of course, we've nationalized the clearing system in the United States.
You gave the example in the United States, the prohibition against interstate banking. But more broadly, why have we moved toward government-controlled currencies? You would think that if free banking were a better solution, there'd be market forces pushing us in that direction.
Before the Civil War, many state governments, in fact, more than half of them, passed what were called free banking statutes. But I have to put free banking in sneer quotes here because they weren't anything close to laissez-faire. What free banking meant was anybody could get a bank charter who met the requirements under the law. And the principal requirements are a certain minimum capital, but more restrictively, a bank had to buy approved assets to serve as a redemption fund for its banknotes, and it would give these assets to the state comptroller. And in many states, it was used as a way of marketing state debt. So if you wanted to issue notes in New York State, you had to buy New York State government bonds. So state governments used it as a way of selling their debt. And that made the quantity of reserves rather inelastic, as they used to say, not responsive to market conditions. And that caused problems. In the Civil War, the Union government said, we need to sell bonds. Who can we sell them to? Oh, look, the state governments are making their banks buy them. We can do that too. So they opened up national bank charters, so-called because they didn't allow nationwide branching. But you could get a bank charter from the federal government, and the office that regulated this still exists, even though the national banks no longer issue currency. It's still called the Office of the Comptroller of the Currency, although it's been 80 years since national banks issued currency. So maybe someday they'll get around to changing the name of the office. The short answer to your question is war finance, specifically the Civil War, is what led to federal involvement in the banking industry. It's one of the first industries to be regulated at the federal level. And the problems of the national banking system, which were due to this restriction on the flexibility of banks in meeting demands of the public, if farm owners wanted to convert some of their deposits to currency so that they could pay their farmhands, the banks would have to say, look, we've issued all the banknotes we're allowed to issue. We can't give you any currency of our own issue. And the farmers would say, okay, well, we'll take coins or greenbacks, which were still in circulation after the Civil War. Taking that kind of money drained reserves from the banking system and is responsible for the financial panics of the late 19th century. And those financial panics could have been treated by moving toward a Canadian-style system that is deregulating, taking away the restriction that was causing the problem. And there were advocates for that, but it didn't win the day in the Congress because the small banks were against it. Instead, we got the Federal Reserve Act, which was like a patchwork trying to provide a more elastic currency. That's the language now in the preamble to the Federal Reserve Act. Allow the banking system to issue more banknotes in seasons of high demand and provide more reserves to banks when they're losing reserves because of seasonal demands. And that was the original mission of the Federal Reserve System. It's a story of an interventionist dynamic where some restrictions led to later restrictions rather than being rolled back to fix the problem they created.
So we have the Federal Reserve founded to provide more elasticity, to provide liquidity to banking markets when they need it.
Right.
And over time, the Fed's mission has evolved now to include flattening business cycles and controlling inflation. And many people, when I describe free banking to them, will come back and say, well, you can't do this without the Federal Reserve because prior to the Fed, business cycles were worse, inflation was worse. What's your response to that?
The problem with financial panics before the Fed was due to legal restrictions on the banking system under the National Banking Acts. Canada didn't have those kind of financial panics.
Mm-hmm.
So there was another way to remedy that problem, consistent with staying on the gold standard, which was to deregulate note issue and to allow branch banking. Branch banking would make the banks better diversified against local shocks, and it would make them better capitalized relative to their asset risks. There was more to your question, though.
In a free banking world with no Fed, we effectively have no monetary policy.
That's right. Without a central bank, there's no monetary policy. But I would argue that the Fed has not improved things. If you look at the numbers in the paper that George Selgin and Bill DeStraps and I published about 10 years ago now, we compared the severity of business cycles and other things under the Federal Reserve's watch to the system before the Federal Reserve Act. Somewhat to our surprise, we found that business cycles have not gotten any less severe. If you look at the Fed's whole history, that's kind of obvious because the Fed's whole history includes the Great Depression. But even if you leave out the Great Depression and say, well, that was just practice, we won't count that, and just look at the post-war period after the Second World War to the present, business cycles measured as variance in real GDP is not any smaller now. It used to be thought that it was smaller now because we had biased measurements of the size of pre-Fed business cycles. The bias comes from the fact that we only had time series on a few commodities, not on the broad array of commodities that we have today. And so just by the law of large numbers, the economy would look more stable today. But when you correct for that, which is something that the economist Christina Romer was mostly responsible for, business cycles aren't any smaller today. We made that observation even before we had data from the financial crisis of 2009 and 10, much less the crisis of the last few years. You would think that the economy would be more stable today because it's less agricultural and it's much better diversified.
Right.
But under the Fed's watch, I should say, business cycles have not been less severe.
Do you see any push for free banking? Do you think this is something that 100 years from now we'll have in this country?
There's something like free banking in offshore banking havens. They don't issue currency, but they conduct banking with much less in the way of legal restrictions. So they don't have capital requirements, they don't have reserve requirements, they don't have deposit insurance rules. And there is a demand for their services. And those banks, as ordinary commercial banks used to do before deposit insurance, have to behave very prudently if they want to attract customers. They have to avoid the kind of risks, duration gap risks, default risks that banks take on today more willingly because their customers are not shopping around for a safe bank since we got deposit insurance. So that's the closest approximation to it. Now, in terms of other demands, I guess we could look at the market for cryptocurrencies. Some of that, people are opting in, not a lot of people, but some people are opting into a system without all the guardrails and controls that the regulated banking system has.
So I want to get your input on cryptocurrency in just a minute, but I want to go back to offshore banking because this is something I know nothing about, other than I know that people, when they want to deride the rich, they'll say, well, they can put their money in offshore banks and then they wave magic wands and get more money. What is the benefit to offshore banking to me as a customer?
Well, it's probably not worth your while if you're just a small saver. They don't take checking accounts. They're not doing that business, but they're intermediating savings into loans. They offer time deposits. And on the borrowing side, they offer loans. Typically, very big loans are booked offshore. So people don't actually go to these islands like the Bahamas or the Cayman Islands to do business. The business is booked there. It's put on their balance sheets that are domiciled in these jurisdictions. And what's the advantage? They have smaller spreads. because they don't have the regulatory burdens that onshore banks have, they can pay a little more on deposits and they can charge a little less on loans.
Are there tax implications?
It's perfectly legal for a U.S. citizen to have money in an offshore bank account, but they have to pay taxes on the interest they earn there, just like the interest they earn anywhere else. And it has to be reported on your 1040.
The questions I have are all around cryptocurrency, and are we going to end up with something that looks a lot like free banking as people opt into crypto?
Well, that's a big question. There are barriers to the entry of crypto banks, at least operating brick and mortar banks, because they have to get bank licenses and they're not doing the same kind of banking that dollar-denominated banks are doing. We've had some unfortunate episodes in recent months with crypto banks. They didn't call themselves banks, they called themselves lenders, but they were taking deposits, offering ridiculously high interest rates on them. And we didn't know what they were doing with the funds. But as some of them have failed, we found out that what they were doing was not lending to respectable borrowers, but they were speculating on the price of Bitcoin, or they were lending to other people who were speculating on the price of Bitcoin. And so we had the crash of Terra, and then many of these other institutions were exposed to that, Celsius, Voyager, and so on. I would think there would be a demand for reputable banking where the banks revealed enough about their balance sheet that you could judge whether they were a safe investment or not. If they won't, then my personal advice is stay away. We also have some crypto banking in the form of stablecoins. Stablecoins are dollar-denominated IOUs, and the funds are being intermediated into portfolios, which we do know a little bit more about. They've been more forthcoming as a matter of competing with other stablecoins. USDC and Binance and other issuers of stablecoins are publishing a summary of their balance sheet and publishing attestations to the accuracy of that summary by auditing firms. And so that's an interesting development. Now, they don't really do lending to ordinary borrowers or to business borrowers, but they invest in treasury bills and some portion into commercial paper.
I'm unfamiliar with stablecoins. Stablecoins, you can convert at a fixed rate to dollars. Is that what you're saying?
Yes. Just like a bank deposit, you can convert at a fixed rate into dollars.
So what is the benefit of having a stablecoin? Why would I want one?
So you can buy and sell stable coins on crypto exchanges. You don't have to send your payment through the ordinary clearing system. So it doesn't go through the central bank. So it's a little bit more private, but it's also just faster and cheaper than wiring money. We tend to think of wiring money as instantaneous, but it's not. It takes a couple of days to clear, actually. People who are buying and selling Bitcoin or Ether, if you're selling Bitcoin, you'd want to be paid in stable coins because you'd rather keep your money in dollars than in Ether. When you decide what you want to buy, then you can buy it with USDC or US dollar tether very quickly and cheaply. Keeping it out of the banking system is faster and cheaper than moving it into the banking system and then back out again.
I can tell you, if I had the option of getting paid in stablecoin when I was working in Iraq, that would have been so far to the good for me, because I would have to send money 3 different times a month to get it back to my wife, who would put it in our account. Dealing with Western Union thrice monthly gets kind of expensive and irritating. Anything that could have gotten beyond that would have been really helpful.
Yeah, so one of the use cases for stablecoins is people who are crypto traders, but another is for international payments. Because when you are trying to send dollars internationally, you've got a double hassle, not only the Federal Reserve System, but it has to go through a foreign central bank as well.
And good luck to you if one of the foreign banks that routes your money is in Iran, because now all of your accounts are shut down and the federal government has to take a look at every single thing you've ever done.
For a lot of people overseas, the option of having a US dollar bank account domiciled in, let's say, New York is a big risk because they could be shut down or censored at any time, as a lot of innocent Russian citizens found out when their government invaded Ukraine.
What's your opinion of a world currency?
Well, I'm all in favor of it if it comes about spontaneously. And I think the international silver standard and following that, the international gold standard were world currencies. And so they brought in the first age of globalization by making it easier and cheaper to move money around the globe. You didn't have to worry about floating exchange rates.
So an example, at least moving that direction, is the euro. Do you perceive that the euro was a good idea, was a bad idea? I know for myself, I was surprised when the European Union formed and then we had the euro, I guess, or maybe it went in the opposite direction. There wasn't a jump in economic activity. It seemed like everything was after the same as it was before.
Well, it was a smaller change than you might think, because what preceded the euro was everybody was on the Deutsche Mark standard.
I see.
At least to the extent they were successful at it, other central banks were pegging to the Deutsche Mark. I mean, there is a difference because those exchange rates were subject to attack, as the pound sterling found out. They had to depeg when they came under speculative attack, whereas being part of a common currency zone eliminates that problem. But I had a certain amount of sympathy for the Euro project because it does reduce the hassle of moving money across borders. And if you have a lot of cross-border trade, that can be a big deal. For the countries in Europe who were not Germany, it was a big improvement in the quality of their money. In Spain, they immediately went down to the German rate of inflation. In Italy and Greece and other traditional high inflation countries, it was a pretty unmitigated gain. Now, what the Germans got out of it is a little less clear. And if it had ever come to a referendum in Germany, I think it would have failed. I think all the opinion polls showed that it would have failed. And that's why the government didn't have a referendum, because they've already got a stable currency. And now they're being asked to share the management of it with people from all over the continent, some of who have ruined their own currencies. But in order to be good Europeans, is the way my European friends explained it to me, the German government agreed to this. One of the conditions was they got to write the constitution for the European Central Bank. And the initial constitution said one goal, and the one goal is price stability. The first resolution passed by the governing body of the European Central Bank was, by price stability, we mean inflation less than 2%. It started off sticking to that, but admitted more and more countries. And Germany no longer is the median voter, is one way of putting it.
Mm-hmm.
It's had periods before where inflation drifted above 2% for a couple of years, but not all that far above. But now inflation in Europe is 9%, and there's no rapid return to 2% in prospect. It's kind of a shame that this last great hope, a fiat money constitution, is basically in tatters right now. And where can the Europeans turn? Because they've eliminated competition among national currencies.
Without creating an entirely new episode, can you talk a little bit about the 9% inflation? I haven't been following what's been going on in Europe. Of course, in the United States, we've got a massive increase in the monetary base going on for some time now. So in some sense, the inflation we're experiencing in the U.S. is not unexpected. What's been happening in Europe to get 9% inflation?
Basically the same thing. European Central Bank printing lots of money to fund anti-recession policies. They've been actually slower than the Fed to start to raise rates. They've just started now, like this month, to raise interest rates, which is, of course, the shorthand they use for tightening the growth of the money supply. In Great Britain, it's even worse. Inflation is over 12%. Many central banks have responded to the pandemic by just opening up the floodgates. They haven't taken the extra money out of circulation promptly. And so now we've got inflation in the dollar, in the euro, in the British pound. It's a little bit less in Switzerland. I think it's only 6%. Some countries have been less irresponsible, but it's a very widespread problem. And of course, in the developing world, we've got 30% inflation up to triple-digit inflation in the worst cases. It's a real crisis in fiat money. Hopefully, it won't last as long as the high inflation of the late 70s and early 80s lasted. Right? That went on for nearly a decade. The Fed is promising, of course, to bring it down rapidly. Let's hope they stick with it.
Do you have a prognosis where we're going with inflation?
In the previous decade, in the 2010s, I made a bet with my former student, Will Luther, that we would see 5% inflation year over year during some month in the 2010s. And I lost that bet. It came close, but it stayed under 5%. I wish we had renewed the bet at the beginning of this decade.
Well, you only lost it by
That's
one or
right.
2 years.
That's right.
About a year and a half.
My current forecast is we're going to have inflation north of 5% for many years. I don't see any great urgency to bring it down if you look at what central banks are doing other than what they're saying. I hope I'm wrong. I hope that Powell is sincere when he says we urgently want to get it back down to 2%. And M2 growth has slowed down in the last 6 months pretty dramatically. Let's hope that continues and that no new crisis comes along where they throw up their hands and say, oh, well, we can't tighten now.
Before we end, Larry, you have a book coming out. You want to tell us a little bit about that?
It's due out in April 2023. The title is Better Money, Gold, Fiat, or Bitcoin? ? It's a head-to-head comparison among alternative monetary standards. The timing is great for the sales of my book that inflation is hitting 9 and 10%.
Right.
It's a re-examination of this question that Hayek raised back in the 70s of whether we wouldn't be better served if we had more competition among monetary standards. And what's different now, of course, is we have more candidates. We have Bitcoin, which is a candidate to be a new monetary standard. And we have the technology of blockchains being applied to kind of modernize the gold standard, make much more convenient the transferability of claims to gold. You can buy Pax Gold or Tether Gold, and you have ERC20 token, which follows the price of gold, and it's very easy to transfer from person to person. I talk about the track record of fiat money. I talk about the track record of the classical gold standard. There's no track record of Bitcoin serving as a commonly accepted medium of exchange, but we can imagine how it would perform if it were the standard money in the system. Not to give too much away, but I think there's an important difference between Bitcoin and the gold standard in terms of the stability of the purchasing power. Bitcoin is more volatile. And that volatility is understandable, but it's built into the architecture of the Bitcoin system because the supply curve is vertical. The quantity of Bitcoin doesn't respond in a way that dampens movements in its relative price or purchasing power.
That actually sounds fascinating. I'm looking forward to having you back in April once that book is on the market.
Okay, we can talk more about it then.
Larry, thank you so much. This has been wonderful.
Thank you, Larry.
My pleasure.
And that's all the time we've got this week on Words and Numbers. Until next time, be sure to follow us on Twitter. Handles are in the show notes. Join Words and Numbers Backstage, the Facebook group where the conversation continues, and
send us email, wordsandnumberspodcast@gmail.com.
Until next week, try to be nice to one person who doesn't deserve it. Just one. And who knows, it may turn into a trend. Give it a shot. You might feel good about yourself.
You could say you tried.
You tried, that's right. Till next week, can't take it easy.
See you next week, James.